Over the last 6 months, many signs have emerged that the U.S. economy is heading for a significant downturn. Some even argue that the crash is already underway. If you've been paying attention to the markets, you're probably feeling the impact. Whether it's the stock market volatility, rising inflation, or concerns about real estate prices, the signs of an economic crisis are hard to ignore. In this video, we'll explore the current economic landscape, what led us here, and what might happen next. Don't forget to like this video and subscribe to our channel to stay updated on the latest insights and trends as the situation continues to unfold. Let's begin by looking at the impact of interest rate hikes on the markets. The Federal Reserve's decision to raise interest rates by 1% or 2% could have devastating consequences for the stock market. During the pandemic, many companies saw their stock prices double, but now those same companies are returning to pre-pandemic levels. This correction in the stock market has many investors worried. Those who sold their stocks before the crash were in the best position to benefit, while others have watched their portfolios shrink. The wealthiest 10% of Americans own the majority of equities, so a downturn in the stock market doesn't directly affect them as much. However, when real estate values drop, it impacts almost everyone since owning a home is a significant part of most people's wealth. In 2020 and 2021, home prices surged by nearly 10%. The last time we saw such dramatic increases in housing prices was in 2005 and 2006, right before the 2008 financial crisis. Now, as the Federal Reserve raises interest rates, home prices are starting to fall, and many are asking, will we see a repeat of the 2008 housing crisis? However, it's important to note that the causes of the 2008 housing bubble were different from today's situation. The 2008 crash was driven by loose banking restrictions, which allowed banks to issue risky subprime mortgages that were bundled into mortgage-backed securities. These securities were then given AAA ratings despite being backed by faulty loans. When these loans started defaulting, major financial institutions like Lehman Brothers and AIG went bankrupt, triggering a global financial collapse. Today's housing market is not supported by these types of risky loans or inflated ratings, which means that the causes of the 2008 crash do not exist in the same way. Mortgage lending is more regulated now, although it is still easier to obtain a mortgage than it was immediately after the crash. But that doesn't mean the current housing market is immune to a downturn. The real estate market has been hot, and home prices have risen dramatically over the past couple of years. As mortgage rates climb due to the Fed's rate hikes, demand for homes will likely fall, which could lead to a decrease in home prices. But what makes this crisis different? After the 2008 crash, many home builders went bankrupt. As home building became unprofitable, the government stepped in with financial support to prevent further damage to the economy. But the housing market struggled for years to recover. The supply of new homes remained limited, and prices grew at a steady, modest pace, generally increasing by just 1% to 3% per year. However, when mortgage rates were historically low and housing demand surged, builders rushed to meet the demand. As the pandemic caused a major shortage of real estate, new housing supply increased significantly, doubling by 2021. Now, as the Federal Reserve continues to raise rates, mortgage rates are climbing, which reduces the demand for homes. In response, builders are cutting prices in an effort to sell homes. As a result, we're starting to see a shift in the housing market, where prices are coming down as sellers struggle to meet the demand at current price points. This is particularly concerning for homeowners who bought during the boom years of 2020 and 2021, when prices jumped by over 20%. Now, with rising mortgage rates and the possibility of a larger economic slowdown, it's clear that prices could drop by 10% to 15%, especially if demand continues to decrease. What will happen if home prices continue to fall? Many people may face tough decisions about their homes. Some will choose to sell, but others may decide not to. Homeowners who purchase properties at peak prices may find themselves in a difficult position, especially if their homes lose value. If the value of a home drops by 10% or 15%, homeowners who took out large mortgages may find themselves upside down, owing more on their mortgage than their property is worth. In such situations, People may default on their loans because it doesn't make sense to keep paying off a mortgage for a property that has lost value. If this trend continues, we could see a significant slowdown in home sales, with sellers forced to lower their prices to attract buyers. Cash buyers, who make up only a third of the market, may be in a stronger position, but most buyers still rely on mortgages. If mortgage rates remain high, fewer people will be able to afford homes, leading to a further decrease in prices. This downward pressure on the housing market could have a ripple effect on other areas of the economy. One of the biggest concerns facing the economy is inflation. As we've seen in previous videos, inflation is at its highest level in decades, and the Federal Reserve is struggling to control it. To curb inflation, the Fed has been raising interest rates aggressively. However, these rate hikes haven't been enough to significantly lower inflation. If inflation doesn't come down, the Fed may continue raising rates, which will further reduce demand for housing and other goods and services. This could push the economy into a recession, which many economists predict is already on the horizon. The global economy is also facing serious challenges, with energy and food crises threatening to exacerbate the situation. Rising energy prices, particularly oil and gas, are pushing inflation higher, while disruptions to global food supplies are leading to higher food prices. These factors will reduce consumer purchasing power, further decreasing demand for homes and other goods. If the economy continues to weaken, the Fed may have no choice but to continue tightening monetary policy, which could lead to further downturns in the housing market. So what does this mean for homeowners and investors? If the housing market drops 10% to 15%, people who bought homes during the pandemic may find themselves in a difficult financial position. In such a scenario, it's important for homeowners and investors to carefully consider their options. While some may choose to hold on to their properties and wait for the market to recover, others may be forced to sell at a loss. It's also possible that the Federal Reserve will face pressure to cut interest rates again to stimulate the economy, but this may only provide temporary relief. At the end of the day, the future of the housing market is uncertain. While it's possible that we could see a housing crash similar to the 2008 crisis, the current market conditions are different. There are no junk loans or inflated ratings supporting the current housing bubble, but rising mortgage rates, falling demand, and inflationary pressures could still lead to a significant downturn. If you found this video helpful, don't forget to give us a like and subscribe to the channel for more updates. Feel free to leave your thoughts and questions in the comments below. Do you think the market will continue to fall, or will prices stabilize? We'd love to hear your opinions on the current state of the economy. Thanks for watching, and we look forward to seeing you in the next video.